We have a very special guest now, Mehul Sukkawala, Senior Director Corporate Rating South Asia from S&P Rating Services is with us. Mehul, you're calling for a corporate Capex to pick up, or you expect a capital investment in India to increase. Why do you say so, and what is the timeline that you're looking at?
Sure. We believe that capital expenditure from Indian corporates will actually decline for the next 12 months. And it's only in fiscal year ending March 17 is when we expect the pickup to happen. The reason behind that is companies, especially in sectors like utilities and infrastructure and metals and mining, are facing a fair level of stress because they have made a lot of investments right now which are not getting optimally utilized. So we believe the management's focus of these companies would be on using their current investments in a more effective manner. And improve their operating performance, improve their leverage, reduce some of the liquidity and in certain cases even covenant pressure. And when things are in a better situation, they will probably consider investing. Also many of the companies we believe are looking for reforms, and that's something which will make the operating environment for them much easier. And that's another factor we believe would influence the decision on when they want to start spending.
Right. You mentioned about the stress in the system, how covenants would start to get slightly on the lower side. Do you think that it'll still need a lot of asset sale, a lot of effort to be done for that to happen, because the stress in the system seems to be quite high?
Right. Definitely, I think we are, along with the focus on operating performance, we are expecting companies to take measures, strategic measures to address the leverage. Interestingly, over the last few months, we have seen that companies in India have been open to selling stakes in some of their assets, which is a little uncommon based on past experience. So that shows that managements want to address the leverage issues. They understand that even the market valuation gets dragged in many cases because of the high leverage. So it's in kind of their interest to do that. Also, another factor we have seen is companies raising equity, leveraging the good market valuation that they have over the last 1 year. That's something which they are using to raise equity and address leverage. So I think managements are taking strategic measures along with focusing on the core operations.
Right. Would you be of the view that there is still excess capacity in the system, and that's why not a lot of investments are being made, because most of the companies are not running on their full capacity?
That's correct. We do see that again in the core sectors like utility infrastructure, metal and mining, a lot of the investments have happened. But especially in utilities, you see a lot of the cases where generation capacities have been set up, but they are not getting optimally utilized. Auto companies in the past have expanded, but because of the demand weakness, they have excess capacity. So I think that's somewhat common across many of the companies, and they would more focus on currently using their existing capacities and then potentially looking at investing in fresh capacities.
Right. What is the sort of growth rate that you see once we have a lot of other reforms coming in? We are already growing as per the new series in excess of about 7.5–8%. Where do you see growth coming in? Because 8%, and we are talking of growth reviving.
Definitely, I think the fact is that a lot of the reforms that the government is doing are focusing on many of the sectors. There are certain sectors which have been performing quite well. In any case, despite all the domestic challenges, they have been performing well, like IT, healthcare, consumer products have been doing quite okay. So I think there are sectors who have been doing well. At the same time, you have sectors which have been facing pressure, and I think if the reforms kick in, definitely we see that one would be consumer demand. If the operating environment improves, their income levels improve, that will help them with more disposable income. And at the same time, you would see the industrial sector starting to make fresh investments, and that in itself can kick in an investment cycle for the country.
But an investment cycle pickup is a must, and you think that private sector should take the hand first, or you think that public investment will start picking up first?
Interestingly, that's a good point. Public sector, if you look at we have kind of looked at the top 100 corporates and a lot of government companies in that list. And if you think of them, actually they have not scaled back their Capex significantly. So in fact, the public sector continues to spend. It's the private sector which is taking a step back. Public sector benefits from good position that many of the companies have in their respective sectors. Also, they have good access to financing. So they are continuing with their investments. It's the private sector which is taking the step back currently. Also, I think government realizes that they need to take the first move, and that's why in the budget you saw that government seems to be taking making the move on increasing the government spending, especially infrastructure sector, where a lot of the companies are not in a position to make fresh investments.
Right. When you released this note, did you speak to a lot of top corporates to try and get their view? Did you get a sense that the environment of doing business is easing out in India?
Yes, as part of our, we cover a large number of companies in India currently, and we are in regular touch with these companies. Yes, some of the things are moving in the right direction. I think on the reforms, the coal auction that happened, that is a step in the right direction. Telecom auctions have gone ahead. So I think there are things moving in the right direction. But at the same time, there are a lot of things that need to be done. We have seen there have been past issues on land acquisition, environmental clearances, the dispute resolution for a lot of disputes that are there in the utility and infrastructure space. So I think there are a lot of things, more things to be done. The companies are getting some of the benefits, but I think they want to see more, because in the past they have been hurt, and we believe they are more cautious now, and they would invest once they start benefiting in a bigger manner from these reforms.
How important will rates be for that?
It will be important in future, especially as I mentioned earlier. Our view is that that investment cycle will potentially revive in fiscal year ending March 2017, and the fact that interest rates are heading lower in India, that's definitely a positive for companies when they are looking at fresh investments, when they go for borrowings. That is something which will definitely help them. Also, in fact, one of the benefits of falling interest rate environment is that the companies which are currently facing pressure to meet their debt servicing, it helps them in kind of reducing the interest outgo that they have to make on their borrowings.
Right. If you look at the rates, what is the assumption that you've made over the next 12 to 18 months? What sort of a rate decline can we see? We've already seen 50 basis points. Any further that you expect sharp rate cuts to come in?
We don't expect a significantly sharp rate cuts. We believe it will be more gradual, and so yes, that's something which we believe will happen over the next 12 to 24 months.
Right. As far as the flows in India are concerned, we've seen flows coming in from FII on the debt side, as well as on largely equity side as well. But it remains vulnerable to global shocks. Some of the other emerging market countries, in terms of their currency, their bond prices, have seen global shocks. How vulnerable would India be to that? And are we in a situation to better handle that situation if there is, say, a currency crisis somewhere else?
I think as compared to probably what we saw maybe a couple of years back, definitely.
You're talking about the 2013.
Yes, that's correct. I think as compared to that, definitely we are in a much better position right now. I think the current account deficit is in more control. Inflation is heading lower. So I think in terms of macro environment, we are in a better position. There is India is seen as one of the few bright spots in the global economy. And so in that respect, it is being seen favorably by investors globally. Now, if things and I think the optimism comes a lot from expected reform, the strong government, and so if that doesn't deliver, sentiments could change, and that could make there could be more volatility again with the US rate hike which is expected. That again, there is risk, but I think we are better prepared now than what we were probably 2 years back.
Right, Mehul. Thank you so much for joining us here this afternoon and detailing how you expect that Capex in India will pick up. Rates will come down, environment will get better, and that will lead to better sort of a Capex investment is what his view is.